So first, let's go ahead and define what technical stock analysis is. So this is the analysis of a stock using charts that display price and volume patterns. Now the goal is to identify entry and exit points through predictive price movements and trends. So as we said before, day traders and short-term traders rely on technical stock analysis. So we were talking about how successful day traders will study a few stocks and learn the personality of them under a variety of different market conditions. And a lot of people will say that, the technicals of a stock are kind of like the personality of a stock or how they react to the market. So what you're looking for are patterns with that stock, and you're looking to realize, okay, this is what tends to happen when you see this chart pattern. Now, there are patterns that we're going to talk about in a little bit that are predictive patterns that apply in most cases, but your best bet is to really study one or a few stocks that you've invested in and learn the patterns of that individual stock and see what happens with it over time. So like we said before, that's really the difference between successful traders and unsuccessful traders, is putting the work in and really studying a small handful of stocks. Now, like I said, this isn't just something that short-term traders should know. I think long-term investors should also learn technical stock analysis, because this will be useful for them to determine the optimal entry point for a position. So you'll be able to look at the technicals of a stock. So let's go ahead and put this all together here. Let's say you're looking to be a value investor. So you're studying the fundamentals of a stock, which we're going to cover fundamental stock analysis next. But let's say you're studying a stock and you're using fundamental stock analysis to determine the value of the stock, and eventually you decide, okay, this stock seems like it's a good price based on the value. And then you're going to study the technicals and say, well, let's look for where the nearest support is, and we're going to buy it when it falls back to that support. Whether that's a simple moving average or whatever it may be, you'll be able to look at the technicals and figure out what is the best possible time to enter a long position for this. So that way you're getting it at a good price, the best price you probably can at that point. Now, I know at some point this does seem like you're trying to time the market, and that can be a difficult thing to do because the market is very erratic, especially, at times, but you can generally look for a major support area and buy maybe 2 or 5% above that support, whatever it may be. Once you understand the technicals, I know a lot of this might be confusing to you now, but once you understand the technicals, you'll be able to realize, okay, so there are patterns and there are things that you'll see commonly with these stocks. But let's just keep moving with it, and it'll make more sense as we go here. Hopefully I'm not totally confusing you guys right now. So when you're performing technical stock analysis, you're going to be looking at the charts. Now, most of us are familiar with line charts. This is what you would see if you went on Yahoo Finance or if you went on Google and looked up a stock. This shows the closing price of a security over a set period of time. Now, most people, as far as their knowledge about charts, it ends right there. They don't know anything beyond the line chart. And the line chart gives you very little information. That is why I really encourage you guys to learn candlestick charts just for your own knowledge. It's such a useful tool. And this is one of my biggest problems. Well, it's not really a problem. I understand why they do this, but this is one of my issues with Robinhood. I love Robinhood. I love the trading platform. As we said before, that's the one I use myself. But I don't use their charts because all they show you are line charts, and that's not enough information. What you need, especially for technical stock analysis, are these candlestick charts. So while line charts are great for comparing a stock to another stock or index, remember how earlier we benchmarked the airline index to the S&P 500. They're a great tool for benchmarking and comparison. But bar charts include a single vertical bar that shows the opening and closing prices of that day. Now, candlestick charts are the basis of technical stock analysis, and the difference between a bar chart and a candlestick chart is that a body and shadow are added to the bar chart, and then it becomes a candlestick chart. So we're going to go over a ton of examples of this, but most people don't use bar charts. Most people either use line charts or candlestick charts, and I'm hoping after watching this you guys are going to be motivated to start studying candlestick charts because they give you so much more information. Okay, so here are a couple of examples of candlestick charts, and based on which chart you look at, they're going to have different color schemes. So I know I have 4 different ones here, but essentially what you have is the bar. That's the real body there. So on the left-hand side, that's the black and white. On the right-hand side, that's the green and red color there. And then you have the shadow. That's what extends up above the body and below the body. So a white or green body represents a closing price higher than the opening price. So if the stock opens and closes higher than the open, you're going to have a white body, and if you're using candlestick or stockcharts.com, which is the site I use, it's going to be a white body. So if you have a white body, it means the stock closed higher than the opening price. Now, if it has a black body, that represents a closing price lower than the opening price, but higher than the closing price of the previous day. So if it closed lower today, but it still is higher than the close of yesterday, it's going to be a solid black body. So it's not going down, but it's going down in terms of that individual day. But as far as the whole trend goes, it's still higher than the closing price from yesterday. And then a red body represents a closing price lower than the opening price and lower than the closing price of the previous day. This will make a lot more sense on the next slide here. We're going to look at an example of a candlestick chart. Okay, so like I said, I use stockcharts.com. It's a free service for all of my candlestick charts. I think it's the best one out there, and you can add all kinds of different technical indicators to it. It's like a one-stop shop for me. I don't mess around with anything else. And like I said, guys, a lot of people are going to try to suck you into paid services and paid platforms. This is something that's totally free. It's been free for as long as I can remember, and I don't expect them to ever change that. So here's a totally free site you can go on to get your candlestick charts. So let's take a look at a few examples here. First of all, we're going to talk about this later, but those bars on the bottom are volume. So that shows the trading volume of that stock, and obviously the black is when the price movement is up, and then the red is when the price movement is down. So a lot of people refer to that as up volume versus down volume. We're going to cover volume later on, but I just wanted to tell you guys what that was. And so basically, you can see the solid white bars are where the price closed higher than the previous day. You can see those solid black bars where the price closed lower than the open, but higher than the previous close. And then those solid red bars are where it closed lower than the open and lower than the previous day's close. So those are the three colors of the bodies that you're going to be looking for. And if you're using stockcharts.com, these are the three colors you're going to see. And then the shadows we see there above and below these bars are the range that stock traded in that day. So you can see some of these have a much larger body and a much larger shadow, and some of them have a much shorter shadow and smaller bodies. And we're going to go over shortly what all of these different patterns mean. But the first thing you guys need to do is really understand what you're looking at here. And now that I've explained these things, you should be able to look at a chart like this and at least be able to look at a single bar here and say, okay, what does this mean? This means that the stock traded higher than it did then it opened that day and closed higher. And then you look at a red bar and you're like, okay, it closed lower than today's close and the previous close. And basically, guys, you're going to be using this to start to look for trends. And there's going to be certain patterns you're going to be looking for that symbolize trend reversal patterns, and we're going to cover those shortly. So why would you learn about chart patterns, especially candlestick chart patterns? Well, candlestick chart patterns can be used to predict price movements. And there are bearish and bullish chart patterns, and I'm sure you guys by now understand what I mean by that. But bearish meaning patterns that indicate that the stock price is going to go down, and bullish indicating that the stock price will likely go up. Now, we will be discussing a few common patterns you should be familiar with, but candlestick chart patterns are an entirely different field of study on their own. I mean, people have written hundreds of pages on this stuff. They've written entire books on candlestick charts, so there is no way I could ever cover everything you guys need to know about candlestick charts. This is everything I know, and this is basically enough for me to perform technical stock analysis and identify good entry points. But people who are looking to use this as their primary method of trading, they're going to want to have a better understanding of this. So because I don't want to make this a whole course on technical stock analysis, I just wanted to teach you guys the basics. But if you're looking to read more about it, there have been entire books written about candlestick chart patterns. And so I would recommend checking out some books. So the first pattern to look for is called the hammer. Now this is a bullish trend reversal pattern. So a hammer is often an indication of the bottom of a downtrend, and the inverted hammer is similar, and it is also seen as a bullish reversal pattern. So on the bottom there, you guys can see what this looks like. It is a short body with a long shadow in one direction for the inverted hammer, and then the hammer is going to have the shadow down below the body. And let's go ahead and look at two examples of a hammer. Okay, so on the left we have advanced micro devices, and as you can see, they had a really bad downtrend there. I mean, if you see how big that vertical red bar is, the stock gapped downwards, and it continued to trend downwards, but then at the bottom, the hammer was formed, and obviously after that, the trend reversed, and the trend was now a bullish trend at that point. So somebody who was watching that, maybe you picked up on that pattern. That hammer is always a good indicator that the bottom has been reached. So that hammer there with AMD was an inverted hammer, and then if you look to the right here, we have a hammer on JCPenney stock. This was back on August 18th of 2017. So this was after multiple days down. You see that hammer forming there, and that indicated the bottom of that trend. So this is a great one to look for. It's called the hammer or the inverted hammer, and this is a sign of a trend reversal or the bottom of a downtrend in most cases. Okay, so the next pattern is called engulfment, and this is a 2-candle reversal pattern. So we have bullish engulfment and then bearish engulfment. So there are 2 different patterns here. The body of the second candle engulfs the body of the first candle. So if it's a bullish engulfment, you will see a wider bullish candle, and if it's a bearish engulfment, you will see a wider bearish candle. And that is indicated by the color of the body itself. So if it's a white body and it's closing higher than the open, that's a bullish pattern. And if it is a dark body and it is closing lower than the open and lower than the previous day's close, then that is a bearish pattern. So let's go ahead and look at 2 examples of this engulfment pattern. So on the left here, where the red arrow is pointing, we have an example of bearish engulfment on Google stock. This was on July 31st of 2017. So as you can see, the red bearish candle totally engulfs the bullish candle from the previous day, and as a result, that trend still continues downward. And then on the right there, we have Chesapeake Energy, CHK. This was on July 10th of 2017. This is a good example of a bullish engulfment. So after multiple days down, you see a bearish candle form, and then you see a bullish candle totally engulf the previous day. And as a result, it symbolized a bottom of that trend, and you saw a slight uptrend after that. So this is 2 examples of the engulfment pattern, and this is another important pattern to look for in candlestick charts. So the next pattern is called the piercing line, and this is a 2-candle bullish reversal pattern. So the bullish candle mirrors the bearish candle as buying pressure increases. So this is going to look like 2 identical candles, and they're going to have a very long body. So essentially it's going to be as if they're mirroring each other, and this is a good sign for a bullish reversal. So this was a bullish reversal seen on Facebook stock. This was back on May 18th of 2017. And as you can see, that bullish candle essentially mirrors that of the bearish candle, and that symbolizes a reversal of that bearish trend, and then the stock ticked upward after that. So this is another good pattern to have in your toolbox. Next we have the morning and evening star, and this is a multi-candle pattern here. So this one is going to be, in some cases, a little bit more difficult to identify, but once you do see these are good patterns to pay attention to. So the morning star is a bullish reversal pattern, while the evening star is a bearish reversal pattern. And this is a pretty easy one to remember. I always think of morning as, we're going into daylight, we're going into good times, and then the evening star is more like it's going into the dark. So that's usually how I remember this as far as bullish versus bearish. One of them is a good thing where we're going into a new day, and the other one, we're going into the dark at that point. So let's go ahead and look at an example of both of these, the morning star and the evening star. So on the left here, we have an example of the morning star with Netflix stock back on April 21st of 2017. And then there were multiple days up in a row, and then the stock gapped open and then went into a nice little uptrend there. So that would have been a good pattern to pick up on. And then we have an example of the evening star. This was on National Oil Well Varco. This was August 7th of 2017. And you can see the evening star pattern formed and resulted in a multiple day downtrend, and then it appears the stock went into a basing period there. And we're going to talk about the stages of the stock coming up shortly. So that is called a dormant or a basing stage there when you're seeing all the patterns trading in a tight price range like that. Okay, so the next 2 patterns are very similar, so I included them in the same slide, but this is the doji and spinning tops. Now, these patterns ultimately represent indecision, and what this means is at that current point in time, the bulls and the bears are even, so the bullish pressure is equal to the bearish pressure. So on the left there, we have spinning tops. They're going to be short bodies. They're actually going to look like a spinning top, so picture a spinning top with 2 sides to it and a very small body. That's what they actually look like. That's why they're called a spinning top. So in that highlighted section there on Etsy stock, we see multiple spinning tops in a row, and this just indicates indecision. And then we have a Doji forming here also on Etsy stock. These are the ones that have a very short and even in some cases no body formed, where the open price is equal to the close price. And then you have the shadow above and below. They should be about equal size. And so as you can see, on the left we have a Doji, and on the right arrow there we have two near Dojis, which might also be considered a spinning top. Once they have a body, they're considered a spinning top, but if they're just a flat line or close to it, they're a near Doji or a Doji. And just remember that anytime you see these, they represent indecision. And it's a good thing to pay attention to a Doji. If you see a Doji forming at the top of an uptrend or the bottom of a downtrend, because that may be a sign that the bears and the bulls are even at that point, and there may be a price movement or a trend reversal at that point. So if you're ever performing technical stock analysis, let's say you're in a short-term trade and you're up on your investment and the day ends in a Doji, or you see it coming close to a Doji, that might be a good indicator that you should take profits off the table, because that is a period of indecision. So that's one of my favorite patterns to look for, is the Doji or the spinning tops, because it represents a time of market indecision where the bulls and the bears are equal. So the next pattern is called the hanging man, and this is very similar to the hammer, because this is basically the opposite version of that. So this is a bearish candlestick pattern found at the top of an uptrend. So while the hammer is found at the bottom of a downtrend, the hanging man is found at the top of an uptrend. That's the difference there. So this indicates a trend reversal may take place, and like I said, this is the bearish form of the bullish candlestick known as the hammer. So here's an example of two hanging man patterns that appeared in Nvidia stock, and obviously that was a very good indicator of a trend reversal, because after the first one appeared, there were 4 days down, and then the second one appeared and it was down another 3 days after that. So that is an example of a hanging man, and this is a bearish candlestick pattern found at the top of an uptrend. That is when you really want to pay attention to this particular candle. Okay, so now we're going to get into the stages of a stock. Now, every stock out there is in one of these 4 price movement stages at any given time. And this could be due to the individual company, the industry as a whole, or market sentiment. And you guys should know about all of these things by now, what these mean. Now, the 4 stages are the accumulation stage, the breakout, the peak, and then the sell-off. And identifying what stage a stock is in can help you better time the entry point. So before you do any kind of investment or before you do any kind of trade, you want to understand what stage the stock is in. And if you can't identify that, then you haven't done enough research. So you should be able to look at your stock. And after you guys go through this section and take some notes and study some chart patterns on your own, you should be able to look at any candlestick chart, and within a couple of minutes, maybe you take out, some pencils and pens and draw on there and draw some things and look at different parts of the chart. You should be able to say, okay, this is what stage the stock is in. And you need to be able to answer that question before you trade or invest in a company, because if not, you don't really know what you're looking at. You got to do some more research. So the first stage is known as the accumulation stage. Now, many refer to this as the basing stage, where the stock is building a solid price foundation. So what you're going to be looking for is the stock price is going to trade within a price range, or it is known as bracketing. So a lot of people are going to say a stock is bracketing or it's basing. What this means is the stock is in the first stage of accumulation. It's building a solid price foundation. So the bulls are going to be pushing the stock higher while the bears push the stock lower. So at that point, it's basically a tug of war between the bulls and the bears, and you're going to see the price just go up and then go back down and then go back up between support and resistance areas, and we're going to talk about that a little bit later on. Now, what's going to happen is eventually the bullish pressure exceeds the bearish pressure, and the stock moves into a breakout. What could also happen, though, is that the bearish pressure could outweigh the bullish pressure, and it could break through that support and go into a downtrend. But we're going to just go through the 4 stages, and you'll understand what that downtrend looks like. But let's say for this example, the bullish pressure exceeds the bearish pressure, and the stock moves into a breakout. So if you were looking at a stock and you determine it is in stage 1, it's an accumulation, what does this mean? Well, the accumulation stage is the time to watch a stock for a breakout in a short-term trade. So if you're looking to trade a stock in the short term, you're looking to do a 2 to 5 day hold, you would want to wait for an indication of a breakout before you invested. Now, the longer the stock is accumulating, the more pressure is built up. So you want to look for a nice, long, healthy accumulation phase. The longer it accumulates, you're usually going to see a more explosive price movement when it does finally break out. Now, during this stage, price fluctuations tend to correspond with market corrections. So again, what you could do is just take a look at a line chart and benchmark it to the NASDAQ or something like that if you're looking at a tech stock or whatever industry it's in. That way you can determine what the price fluctuations are. They should be close or equal to whatever the market correction is. But here on the bottom here we have an example of an accumulation phase. As you can see, it's bracketing in a tight price range there, going up and down, and then eventually it breaks out. Okay, so you see it has multiple days, or I think that was probably about 2 weeks up, and then it goes into another accumulation phase. So somebody who was looking for a short-term trade, maybe they recognized signs of a breakout, and they picked it up at that point, and they had a nice couple days up, and then it goes back into another accumulation phase. So this is what accumulation looks like, and then it eventually will give way to a breakout, or it may give way to a downtrend. Okay, so now we're going to talk about the second stage, the breakout. So essentially what happens at this point is the price continues to oscillate, but the overall trend is now upward instead of lateral. So before, when it was in the accumulation phase, it was oscillating or bracketing, which just simply means going up and going back down, but in a lateral price movement. Now it's going to oscillate, but the overall trend is going to be upward, so it's going to be moving in an uptrend at that point. Now, bullish buying pressure at this point is greater than the bearish selling pressure. Now, a swing trader looks for the early signs of a breakout and buys the stock, typically hoping for a 5% price move or better. So if you were a swing trader, what you would be doing is you would be having a number of stocks that you were watching that were in the accumulation phase, that were forming a nice healthy base, and you're waiting to see the signs of a breakout, and then you would buy once you see the stock break out above that accumulation phase, and you would hold it for the duration of that breakout. Now, a breakout can be followed by another accumulation stage, like we saw in the previous example, or a peak. So then it will come to a peak, or you may see an abrupt downtrend. So you want to be careful when you're holding a stock in a breakout, and a lot of people make the mistake of getting greedy. If you're a good short-term trader, you have a set price point in mind that you're going to be selling at, but a lot of beginners get greedy and they go above that because they want to chase higher profits. And like we said, a breakout could be followed by an abrupt downtrend. So that's why a lot of people make the mistake of riding a winner into a loser, because they get greedy. But this is what you're looking for in a breakout. So here's what a breakout is actually going to look like. And typically a stock with a longer accumulation stage will have a longer breakout stage. So like we said, when you're looking at stocks in the accumulation stage, the longer they've been in that accumulation or that basing stage, the more explosive the price movement is going to be out of that. So holding a stock in a breakout is risky because a trend reversal can happen quickly. So if you're somebody who is looking to trade in the short term, you want to set your stop loss points, and you want to make sure you lock in profits as soon as you can, and you don't want to get greedy because you always want to sell when you can, not when you have to. So on the bottom here, we have a perfect example of a breakout that resulted in an abrupt downtrend. So obviously the stock was going up and up and up. It came to a peak, and right after that went right into a abrupt downtrend. So this is something you could be caught up in. That's why you always want to make sure you're selling when you can. You're selling at your set point, whatever that may be, and you're not going to be riding a winner into a loser, because sell-offs can be very abrupt. And you also have to remember that the emotion of fear is much stronger than the emotion of greed. So a sell-off is going to be much more volatile and abrupt than a uptrend. So anytime you're caught in a sell-off, it's going to happen much quicker than that uptrend took place, because people get very scared and they're going to be selling because they are fearful. And the emotion of fear is much stronger than the emotion of greed. But I want you guys to write this down or ingrain this in your memory. I want you guys to remember this. Always sell when you can, not when you have to, because you always want to be in control of the market. And if you're selling because you have to, that means the market is in control of you. So especially with short-term trading like this, you want to make sure you set a goal for what you're going to sell at, and you want to make sure you don't let yourself get greedy and then have the market be in control of you. So the next stage is stage 3, and this is known as the peak. So essentially this is when the bulls see an opportunity to take profits, or they may have doubts about the long-term uptrend. They may have doubts about how high the stock has been trading, and they're going to say, you know what, this is a good time to take profits. So at this point, sellers are going to outnumber the buyers and the supply begins to exceed the demand. Remember guys, all of this is controlled by supply and demand, which are also controlled by the fear and the greed, the market sentiment. So at some point, the supply is going to begin to exceed that demand, and the selling pressure is going to outweigh the buying pressure. And this is when a stock begins to peak. Now, a peak is a very volatile time for a stock because, as we said, once people get fearful, it's going to be a very quick downtrend because the emotion of fear is much stronger than the emotion of greed. So price movements can be abrupt. So if you're holding a stock and you're in a short-term trade and you see the stock peak, this is a time for you to take profits. Now, as a long-term investor, you're not worried about these short-term price movements because you're looking at the long term. But if you're a trader and you're looking at a short-term trade, this is time for you to say, okay, it's probably time to take profits off the table. Now, a peak can lead to another breakout if bullish pressure builds through the accumulation phase. So if you see a peak leading to accumulation, you might want to wait for another breakout to re-enter that position. But in most cases, when you're seeing signs of a peak, this is a very volatile time to be holding for a short-term trade. So at that point, you're going to see the stock go into another accumulation phase, or it's going to enter the final stage known as a sell-off. So here we have an example that shows us all of these four stages here in action, and this is Sears Holdings. This is SHLD. So as you can see, what we have circled is what are the peaks of this movement. So we have 3 peaks in this chart. So starting all the way from the left, we have a peak that leads to an abrupt downtrend. So look at that price movement, multiple days down, which eventually led to another accumulation phase as buyers began to support the stock price. It began to accumulate there for a little bit, it began to form a base, but it just wasn't enough, and the selling pressure again outweighed the buying pressure, and we entered another sell-off. So as you can see, that's followed by a multiple week sell-off. You see it kind of level off at the bottom, and this time there's no accumulation phase. It goes right from a sell-off into a breakout. So while you will see these patterns when you look at stocks, you might not see them all. So you may see a sell-off result immediately in a breakout. So in this case, the sell-off goes right into a strong breakout. So after that breakout, we result in another peak, and that peak results in another downtrend, and that downtrend immediately turns into an uptrend into another peak. And then on the right, we finally see what looks like a healthy accumulation or a healthy bracketing phase where you see a very orderly price movement there where it's just going up and down and oscillating at that point. So this is a little bit more volatility than I would be comfortable with for a swing trade. Sears is a tough company to invest in or trade right now because it is so volatile, but it was a perfect example of showing you guys how erratic these stages can be and how they don't always go in order. So while it makes sense on paper, you're not always going to see them play out in the way that it makes sense on paper. You're not always going to see them go in the right order. You may see stocks that switch certain stages or skip certain stages. So now we're going to talk about the fourth and final stage, which is the sell-off. So this is when bearish pressure increases and the bulls refuse to support the price at this level. And short sellers or bearish investors are having a heyday at this point. This is when they're going to start short selling the stocks. So prices will fall significantly faster than they rose. And as we said, this is because fear is much stronger than the emotion of greed. So we're going to discuss this more in Module 9 when we talk about the psychology of the stock market. But just understand that a sell-off is going to be much more abrupt than an uptrend is going to be. So a short-term trader is on the sidelines during a sell-off, or you should be anyway. If you're caught up in a sell-off, then you were greedy and you didn't sell at the right time, because you should never really be caught up in a sell-off because you would have recognized a peak was forming. So unless you're short selling, unless you're a bearish short-term trader, you're on the sidelines during a sell-off and you're going to be waiting for that stock to form another accumulation phase and then let it build in the accumulation phase for a good period of time. So as a bullish short-term trader, you want nothing to do with a stock in a sell-off. Now, a sell-off ends as bulls begin to support the price, and a sell-off can end in a gradual decline or an abrupt peak. So a sell-off can be followed by an accumulation stage or immediately followed by another breakout. So as we saw with Sears, there were 2 occasions there where the sell-off resulted in another breakout immediately, and this just depends on the volatility of the particular stock. And Sears was a very volatile stock at that point when we were looking at it. So most short-term traders look for stocks that form a solid base. So if you're seeing a stock go right from a downtrend back into an uptrend, that isn't a solid foundation. There's no foundation being built there. And as a short-term trader, you probably would be hesitant to pick up a position because there's not a healthy base being formed there. So now we're going to be talking about support and resistance. So the support and resistance areas are a result of the market supply and the market demand for a particular stock. And it's very simple to understand, guys. I drew a drawing down here. So the blue area there is one support and resistance area, and the green area on top is another one. So as the stock moves upward, you're going to eventually see it move downwards, and that's due to the supply and the demand. So when the stock is moving upward, that means the demand is exceeding the supply, and then eventually it peaks, and then the supply is going to exceed the demand, it's going to go back down. Now eventually, as you can see with the larger line there, that demand is going to exceed the supply, and it's going to push it past that ceiling. Now what's important to remember is that in many cases, the original resistance is going to serve as a support area for that stock. So the resistance is going to become the next support. And again, if a support is broken, that's going to become a resistance. So this is a perfect example right here. And one example that people like to use is think about like a bouncing ball. If you were bouncing a ball in your house, it's going to bounce from the floor back to the ceiling and back to the floor. And imagine if you bounce that ball high enough and it breaks through your floor and then goes to the second floor of the house. At that point, the initial ceiling is going to serve as a support for you to bounce off of, and eventually it falls back through. But this is what it looks like. This is support and resistance areas, and you're going to see this with any stock in the accumulation phase. So a support or resistance is actually going to be a price zone, and a stock in the accumulation stage is bracketing between the support price and the resistance price. Now eventually the bullish pressure pushes the stock past the resistance price, and the old resistance price becomes the new support price. Now if bearish pressure pushes the stock below the support price, it will likely become the new resistance price for that stock as it tries to find a new base below it. So this may be a little bit confusing, but we're going to show an example of this on the next slide here. So here we go. First of all, you can see the support area for the stock on the left as it is bouncing off that support, but eventually it breaks below that, and that support becomes the new resistance, and it finds a new support below it. And as you can see, that previous support is now serving as a resistance area for that stock where it can't break above that. And then eventually it falls below that support becomes the resistance. Now we're about 2/3 through the chart there, all the way in the bottom there. That final support is met, and that stock does eventually break above that previous support or the new resistance, and then that old support from the very beginning serves as a resistance point again. So remember that old support points and old resistance points are going to be areas that a stock are going to be hung up on. So you want to pay attention to your support and resistance areas. And when you're performing technical stock analysis, one of the best things you can do is just draw these in yourself, so you get an idea of what areas a stock is going to have difficulty moving through as far as a price zone, and where a stock may fall for support. So let's talk about a few buy signals based on the technicals we've discussed so far. So if you are taking a short-term position, there are a few things you want to look for as far as the stages of a stock go. So if a stock breaks out of the accumulation stage, this may be a sign of a breakout. And at that point, it's breaking through that resistance, and that old resistance should serve as a new support. Now, one important thing to remember is that you may want to wait to see it test the support for confirmation of this trend. So you want to see it test the old resistance as a support. So maybe it falls to that point and continues in that uptrend. That is a good way to make sure you're confirming that this is the case. And this is a good sign that the stock may be entering a breakout stage. So leaving stage 1, the accumulation stage, and entering stage 2, the breakout stage. Okay, so now we're going to talk more about lateral stock movement. So we call lateral stock movement the accumulation stage. But there are, however, different types of lateral stock movement. So while this is called accumulation, there are different types of accumulation out there that you guys should be familiar with. So the types of lateral stock movement are bracketing, there's congestion, and then there's consolidation. Now it's very important to understand these things because there are two of these movements that are indicative of a healthy base being formed, while one is indication of an unhealthy base being formed, and you do not want to be considering an investment in a stock that is showing signs of this type of movement. So we're going to discuss all of these right now. So first of all, we have bracketing, and this is when a stock is moving up and down in a predictable manner, bouncing off the support and resistance prices. This is a very orderly pattern. It looks just like you would expect, just like that drawing in the previous slide there with the arrows going up and then back down, back up and back down. So this is a stock that would be on your watch list as a short-term trader. It has a very consistent and predictable price movement, and eventually you're going to look for it to break out above that resistance price. But this is what bracketing was going to look like. This is a lateral type of stock movement. This is a type of lateral stock movement, and this is a stock you would want on your watch list. So next we have consolidation. Now consolidation is a very similar price pattern to bracketing, but the stock is trading in a very tight price range instead of having a wider open space. So less volatile stocks often go into consolidation stages when forming a base. And this again is a stock that would be on your watch list as a short-term trader. So this looks just like the bracketing phase, but it's going to be in a much tighter price range. And again, this is a stock you would want on your watch list as a short-term trader. And then we have congestion. Now this is when a stock is moving laterally in an erratic and disorderly manner, and this is typical of a stock with high volatility. Now, these price movements are not predictable, and this is a type of lateral stock movement you want to avoid. So if you're looking at a stock and you see it doing a lateral movement and you believe it's in congestion and you see a price movement that looks like this, or just an erratic and unpredictable price movement, you do not want to be considering any kind of trade with this stock because this price movement is not predictable and the stock is just too volatile. So as you can see, this stock was trading laterally, but it eventually broke out and gave way to a downtrend after that. But if you look at the actual trend itself, if you look at the actual lateral movement, it was very erratic and very unpredictable. So this is not something you would want to see out of a stock that's in stage 1. So here are a couple of technical sell signals you guys should be familiar with. So if you are taking a short-term position, here are a few red flags to look out for. So if you see multiple failed attempts to break through a resistance, this is not a good sign. And if a stock falls below a support and the support becomes a resistance, this is again not a good sign for a stock. And if a stock makes a new low below the previous 3 lows, this is called the pivot low. This is another bad sign for a stock. And a lateral pattern of congestion, especially when a stock is nearing a peak. So you never want to be holding a stock in congestion. If you see a stock and it is having an erratic lateral price movement that you believe is a period of congestion, you're going to want to be on the sidelines. You're going to want to get out of that stock for a short-term trade. So now we're going to talk about volume. Now volume is the number of shares traded over a specified period of time. So most technical traders look at daily and weekly volume to pick up on developing trends. And as we said before, it's going to be displayed on the bottom of your chart. And if you're using that stockcharts.com site, it's going to show up at the bottom. But gray volume is called up volume because the stock closed higher that day. And red volume is called down volume because the stock closed lower on that day. So when you think of volume, just think of energy being directed to a price movement, whether it's an upward price movement or a downward price movement. So volume can direct energy towards an upward or downward stock movement, and the indicators we will discuss going forward are all derivative of price. So what I mean by that is they are all formed based on analyzing the price. Now, why I like volume is because volume is an independent technical indicator, and as a result it has nothing to do with price, and this makes volume an excellent confirmation tool as a result because every other indicator is a derivative of the price of the stock. So here are a few rules of volume you guys should be familiar with, and this would be a good thing to write down or revisit in the future, but the price movement should always follow the volume expansion or contraction. When volume expands, the price is going to expand higher or lower, and this is based on whether it is up volume or down volume. Now when volume contracts, the price movement should also contract. Now when volume expands and the price does not, this is a technical signal known as price-volume divergence, and we're going to discuss this in the next slide. So price-volume divergence. If volume expands and the price does not, this typically means one of two things. The first is a negative confirmation of the price correction, and the second is the price expansion is delayed. So always pay attention to a price-volume divergence because this is a very important signal to look at. So next we're going to talk about volume strategies as far as short-term trading strategies. So this is things you want to look for. So look for a stock to break out of a well-established base on high volume, because remember, volume is energy being directed to a price movement. So you want to see a high volume breakout. That's a very good sign. You want to always look for volume to contract when the price contracts, because what this means is if volume contracts during a price contraction, most investors are holding. If volume does not contract during a price contraction, many investors are selling. And you do not want to see high volume selling pressure during a peak. So a high volume price contraction is a key bearish technical signal. So if the price begins to contract or level off on high volume, that is a very bad sign. That means many investors are selling and they're not holding. Now, if a stock is seeing rising volume while in the accumulation stage, this is a buy signal, and eventually that breakout is going to be more explosive. Another thing to look for is if a stock is in a multi-day uptrend and volume is tapering off, especially if a doji or a spinning top is forming, take profits off the table. So you want to see volume following that price movement, and if volume is tapering off, that means that the bullish pressure is tapering off as well. That means less people are buying and the demand is lowering. Now again, if you see a doji or a spinning top representing indecision, this is a good indicator that it's time to take profits off the table. You want to also always pay attention to a volume spike, especially in an overextended uptrend or downtrend, because a high volume spike is often a sign of a trend reversal looming. So a high volume spike at an overextended uptrend is a good indicator that you're going to be seeing a peak or a downtrend, and a high volume spike at an overextended downtrend is a good indicator that that trend will be reversing as well. So now we're going to talk about the technical indicators I follow that are a derivative of price, and the first is the simple moving average. So a moving average is the average price of a stock over a designated period of time, and the 20-day simple moving average is the average closing price of that stock over the last 20 trading days. Now, a simple moving average is a lagging indicator because it is using data from the past trading days. And simple moving averages work best with a stock in the breakout stage or the sell-off stage. So when a stock is trading in a lateral price movement, the simple moving average is not as good of an indicator as it is when you're in an uptrend or a downtrend. So as far as the simple moving average goes, and this is something you guys can look at on that stock charts website I was talking about, you just turn it on at the bottom. The moving averages most technical traders watch, and these are the ones that I watch as well, are the 20-day, the 50-day, and the 200-day simple moving average. Now, the simple moving average is often a strong support or resistance for a stock. So if you're looking to identify the support and resistance areas, a great place to start is by looking at the 20, 50, and the 200-day simple moving averages. Now, the 200-day SMA, or simple moving average, also known as the power line, is a very strong support or resistance for a stock. So if you ever see a stock fall below the 200-day simple moving average, that is going to be a very strong resistance for that stock. So here's something you're going to want to look for when it comes to simple moving averages as far as any stock you're going to trade or invest in. The optimal buy signal for a stock based on the simple moving average is having all of them in order from lowest to highest on the chart. So for this, I included 4 here just for the example. We have the 20-day simple moving average, the 40, the 50, and the 200-day SMA. So the 20-day should be the highest, the 40-day should be second highest, the 50-day should be the second lowest, and the 200-day should be the lowest. So for example, if the 200-day simple moving average was above the 50-day simple moving average, that's not a good sign. Or if the 40-day was above the 20-day, that's not something you'd want to see. So here we have an example of what you would want to see. If you look on the top left, you can see the green line is the 20-day simple moving average, the blue line is the 50-day simple moving average, and the red line is the 200-day power line, or that simple moving average. And as you can see, the 20-day is highest on the chart, the 50-day is second highest, and the 200-day is lowest on the chart. So this is the optimal signal for as far as simple moving average goes, in what order you will see them. Now here we have Sears Holdings. Before that was Procter & Gamble on the previous chart there. But as you can see here, the 200-day simple moving average is highest, the 20-day simple moving average is second highest, and the 50-day simple moving average is lowest. So this is not what you want to see. This is not the order you want to see these in. But if you guys actually look here, I just want to show you an example of how these are strong support and resistance areas. If you look on the right there past August, the 200-day simple moving average was a resistance area for that stock, and then the 50-day simple moving average served as a support for that stock later on. So you can see these are strong support and resistance areas, and the trend largely followed that of the 20-day simple moving average as well. So this is a good example of how this is a support and resistance area for a stock. But again, this is not the optimal thing you want to see, because the 200-day simple moving average is above the 20 and the 50. So what are the buy signals when it comes to the simple moving average technical indicator? Well, the main buy signal to look for is a crossover or a faster moving average from below. So if a stock has had short-term turbulence and the 20-day simple moving average is below the 50-day simple moving average, and both are above the 200-day simple moving average, a crossover of the 20-day simple moving average is a bullish signal. However, in a bear market, you do need to remember that many stocks will fall below the 200-day simple moving average due to the market correction. So what I'm saying by this is, if you're looking at a stock and your simple moving averages are not in order, so maybe the 20-day simple moving average is below the 50, but you eventually see the 20-day crossing above the 50-day simple moving average, that is a good buy signal based on the simple moving averages. That's a good indicator to see. So the next technical indicator that I use is the Relative Strength Index, or the RSI. And this is a single line oscillator that measures the relative strength of a stock compared to its own price history. Now, an oscillator is a momentum indicator that tells whether a security is in an overbought or oversold condition. And this is pretty self-explanatory, but if a security is overbought, it is trading at the upper end of its current price range and may be due for a correction. And if a security is oversold, it is trading at the lower end of its current price range and it may be due for a correction as well. So we're going to look at an example of what this RSI indicator looks like here. So at the top, we have GBTC, which is a Bitcoin investment trust. And as you can see on top, it's indicating an overbought condition based on the green lines there, or the green fill on that chart. So the RSI is plotted on a vertical scale ranging from 1 to 100. And an RSI below 30 is considered to be oversold, while an RSI above 70 is considered to be overbought. So in a bull market, many stocks are trading at or above the overbought territory, and this is largely due to the fact that many investments become overpriced and things become too expensive. So two examples here. As we said, we had the Bitcoin investment trust was indicating overbought on the RSI, and then AOBC, which is the American Outdoor Brands Corporation, was indicating oversold on the RSI. This is a good indicator of the strength of that price movement and whether or not the stock is oversold or overbought. So next we're going to talk about gaps. Now, gaps are open spaces in price patterns resulting from an absence of trading at that price level. So how does a gap happen, or how does a gap form? Well, basically, if there are a large number of orders before the market opens, the stock will gap higher or lower based on the demand or the supply. Now, gaps are going to fall into one of three categories. You have a breakaway gap, an exhaustion gap, and a runaway gap. And you guys should be familiar with all of these things. It's very similar to the three different types of lateral stock movement. And just like that, two of these gaps are healthy gaps, and one of these gaps is considered to be an unhealthy gap, and one you would want to watch out for. So first we have the breakaway gap, and this type of gap signals the start of an important price move. So a breakaway gap happens at the beginning of a large upward movement. So obviously there was an absence of trading due to a large number of buy orders. The demand drove the price up and the stock gapped open, and this breakaway gap symbolized the beginning of a very strong uptrend for this stock. And as you can see looking at the volume, this was a breakaway gap on strong volume, good up volume at that point. Now, an exhaustion gap is the type of gap you would want to watch out for, and this is a gap that takes place during an overextended uptrend. An exhaustion gap is immediately followed by a peak or a sell-off, and it's funny, the only example I could find of an exhaustion gap was from some Spanish site, but nonetheless, it's a good example. As you can see, it takes place during an overextended uptrend, and it immediately resulted in a peak and then followed by a downtrend. If you suspect an exhaustion gap has taken place, that is a good indicator that it's time to take profits off the table, and you might want to look for lower volume after that takes place, or just a gap at the top of an overextended uptrend. Maybe your RSI is reading overbought, and then you see an exhaustion gap. You might say, hey, it's probably time to take profits off the table here. And then you have a runaway gap. Now, this type of gap appears midway into a strong uptrend or downtrend, and again, this is a healthy gap. There's nothing wrong with seeing this. Basically, it happens during the middle of an uptrend, whereas a breakaway gap appears at the beginning of an uptrend. And then this picture here just gave a good example of what these gaps are going to look like. So on the left we have common gaps. Now a common gap is a result of normal market fluctuations or corrections, and it is not an indication of a major price movement. So you're going to see common gaps taking place. You just pretty much want to associate these or understand that these are just due to market corrections. Now first we see the breakaway gap. This is the sign of an uptrend. That leads to a runaway gap, which happens during the middle of an uptrend, and then at the top of an uptrend, when that uptrend becomes overextended, you'll see the exhaustion gap, resulting in an immediate peak and then a downtrend. So this is all the gaps you're going to see. 2 of them or 3 of them really are very healthy. Common gaps, breakaway gaps, and runaway gaps are things that you're going to see, but if you do see an exhaustion gap, that is a good sign that it's time to take profits off the table. Okay guys, so like I said, this is pretty much just the basics. These are the indicators that I use myself, and there are hundreds of them out there. So this is just a few of the many technical indicators you can use when analyzing a stock. And while it is good to familiarize yourself with others, avoid falling into analysis paralysis. And it's so easy to do this today because there's just so much information out there. And if you try to take in too much, you're really just going to overwhelm yourself and eventually do nothing. You're going to analyze too much to the point where you make no movements. You do nothing at that point because you are just so confused and overwhelmed with information. So at a certain point, you will be looking at too much and finding a lot of contradicting signals. And your best bet is to study many technical indicators, but only stick to the ones that really make sense to you. So I exposed you to the ones that I like, the ones that I follow, and the ones that make sense to me. And that's why I shared these with you guys. Now, some of you may not like these, or some of you may want to study more technical indicators, and I certainly encourage you guys to do this, but I just don't want you to overwhelm yourself with indicators to the point where you're just confused and trying to study too many indicators. So if you guys want to learn more about this, there are so many books and resources out there about technical stock analysis. I just wanted to expose you to the indicators that I pay attention to as a short-term trader, and also the indicators and chart patterns I look for to identify the best time to enter a long position.